How does a Murabaha contract work in Halal Finance? In recent days, the topic of Murabaha contracts has gained attention among those interested in Islamic finance. Many people are searching for clarity on how this financial tool operates. If you are curious about ethical financing options, you are not alone. A Murabaha contract is a specific type of sales agreement commonly used in Islamic finance. This contract complies with Shariah law, which prohibits interest. In a Murabaha contract, the financier, often an Islamic bank or investment platform, purchases a good or asset requested by the client. The financier then sells that good to the client at a marked-up price. This price includes a profit margin that both parties agree upon in advance. The client repays this price in installments over a set period, rather than paying interest on a loan. One key feature of a Murabaha contract is that the financier must first own the asset before selling it to the client. This ensures that the transaction is a genuine sale rather than a loan with interest. The profit margin is fixed and disclosed at the time of sale. This provides transparency and certainty for both parties involved. Clients benefit from acquiring the asset with deferred payment, while the financier earns a profit through the sale price instead of interest. Murabaha contracts are often used for financing goods, commodities, or trade-related assets. This makes them popular for both business and consumer financing under Islamic principles. An example of a Murabaha contract in action is when an investment platform raises funds from investors to buy goods requested by a business. The business then repays the purchase price plus a profit margin in installments. This structure protects investors while complying with Shariah rules. Recently, Murabaha contracts have been applied in large-scale trade finance and recovery efforts. For instance, a $150 million United States Murabaha facility was created to support economic recovery in Turkey after the 2023 earthquakes. This facility provided Shariah-compliant working capital to small and medium enterprises affected by the disaster. Murabaha contracts play a role in ethical and socially responsible financing. They work by having the financier purchase an asset and resell it to the client at a known profit margin, with payment deferred. This structure aligns with Islamic finance rules by avoiding interest and ensuring transactions are based on tangible assets and transparent pricing.